At a Daily Journal shareholder meeting back in February 2022, Charlie Munger predicted that there would be trouble ahead for the stock market. As it turns out, he was right. The S&P 500 is down 20% as of now, and interest rates are continuing to rise. Recently, data from the Bureau of Labor Statistics showed that over the past year, the cost of goods and services, as measured by the Consumer Price Index, has risen by 8.3%, and this trend looks set to continue. Even though gas prices are down 30% since June of last year, 2022, existing data suggests that inflation is still a major concern. And this means that the Federal Reserve is likely to keep raising interest rates, as they did recently with a 0.75% hike. So in this video, we're going to talk about what investors should expect during the inflationary period of 2023, while getting help from our friend and prominent investor, Charlie Munger. Charlie is great to listen to on this topic because he's 98 years old, so he's seen it all. The high inflation of the 70s, the low inflation of the 60s, and even the Great Depression in the 30s. But what's happening now is similar to the 1970s, and Charlie is worried that it might actually be worse than before. In the past, Paul Volcker helped reset the system, but we'll have to see what happens this time around. Take a listen to this. I find it interesting that everyone has strong opinions about politics these days. Even small things get heavily analyzed. With the current political climate being so tense, it's unlikely that someone who's read a book by Paul Volcker would be chosen as the next head of the Federal Reserve. Volcker was the head of the Federal Reserve in the 1970s and raised interest rates to 20% to control inflation. But his actions caused a recession. Nowadays, because recessions and other economic indicators are so politicized, a future leader of the Federal Reserve may not have the political will to make difficult decisions, even if it means causing a recession. This could lead to stagflation, which is a situation where inflation remains high, but the economy struggles. It's a perspective shared by Charlie Munger, and let's hope it doesn't come true. So it sounds like we're in a bit of a pickle here. The Federal Reserve, or Fed, has been printing a lot of money to try and stimulate the economy, but with all that extra cash floating around, it's made prices go up, which is what we call inflation. This is a bit of a double-edged sword because on the one hand, it's suitable for people who own assets like stocks or real estate. After all, those things tend to go up in value when there's more money around. But on the other hand, it's not so great for people on fixed incomes or for the price of things like groceries or rent, because those things are getting more expensive. And it's not just the general population that's feeling the squeeze, it's investors too. When the Fed prints all this money, they also tend to raise interest rates to try and keep inflation in check. And when interest rates go up, it makes it harder for businesses to borrow money and for people to afford things like mortgages or car loans. So a lot of companies might start to struggle and their stocks might go down. So where does this leave us as investors? Well, traditionally, people have looked at things like treasury bonds as a safe place to put their money when the economy is looking a bit shaky. But the problem with bonds is that they tend not to do all that well when interest rates are rising. Because as rates go up, the value of existing bonds goes down. So you might not be losing money, but you're not making much either. Therefore, it's a tricky situation. Cash is losing value due to inflation, and investing in stocks or bonds comes with its own set of risks. It's important to stay informed and make the best decision for your investment portfolio. Charlie believes that sometimes we need to make the best of a difficult situation. He's referencing Warren Buffett's first rule of investing, which is not to lose money. The market can be challenging at times, and it's essential to accept that we may not always make huge gains. However, we can still make smart investments by staying rational and thinking long-term. He suggests focusing on investing in high-quality stocks instead of constantly buying and selling different ones. The key is to find a few golden opportunities throughout our investing career and stick with them for the long term. This approach may not make us rich overnight, but over time, it will pay off. Charlie also acknowledges that the market can be unpredictable, and there may be times when we see a loss. But it's important to keep in mind that this is just part of the process. His strategy is to invest in a collection of reliable stocks that have proven successful over time. It may not be perfect, but it's good enough for him. Nowadays, with all the information available in the media and the pressure to constantly make trades, Charlie believes it's important to take a step back and look at our portfolio from a long-term perspective. This can help us make better decisions and avoid being swayed by short-term market fluctuations. From the Daily Journal annual meeting, it looks like we may be heading toward a recession, and on top of that, inflation is still a concern. This means that when it comes to investing our money, we need to take into account how inflation might impact our investments. But as the saying goes, every cloud has a silver lining. One strategy that might help us navigate this tricky economic landscape is something that investing legend Charlie Munger has advocated for: focusing on a small number of really strong investment opportunities. Munger suggests that instead of constantly adjusting our portfolio based on macroeconomic conditions, we should build our investments with all possible scenarios in mind right from the start. By keeping our portfolio small and selective, we're already positioning ourselves to weather any economic storm, whether it's inflation, recession, or even a good economy. It's a smart approach that can help us make the most of our money even in uncertain times. During a recession or high inflation, people tend to focus on buying basic necessities. This means that items like food and cleaning supplies, typically found in a grocery store, tend to sell well. These are considered consumer staple items and are essential for everyday living. People tend to focus on purchasing these items rather than discretionary items like luxury goods, appliances, new cars, or home improvements. Additionally, during a recession, people may shift their spending habits when it comes to food. Instead of dining out at restaurants, they may opt to buy groceries and cook at home more often. This is because when money is tight, people tend to prioritize spending on necessities like food, housing, transportation, utilities, and insurance. This means that there might not be enough money left over for non-essential items, so people tend to cut back on discretionary spending to make sure they can afford basic needs. When the economy is in a state of stagflation, it can be a challenging time for businesses and individuals alike. High inflation, which is a sustained increase in the overall price level of goods and services, can lead to increased cost for businesses, such as higher labor costs and higher wholesale prices for products. This can significantly impact the profit margins of businesses, even those that are considered essential, such as grocery stores and dollar stores. Furthermore, during a recession, consumer demand tends to decrease, which can lead to a decrease in revenues for businesses. This combination of high expenses and reduced payments can create a perfect storm for businesses as they struggle to maintain profitability. To mitigate these economic pressures, Charlie Munger has built a portfolio of companies that can withstand these challenging economic conditions. He focuses on investing in companies with strong fundamentals who can generate consistent profits even during tough economic times. This can include companies that have a strong brand, a loyal customer base, and a diverse range of products or services. By investing in these types of companies, Munger aims to mitigate the risks associated with stagflation and position his portfolio for long-term success. When the market is highly volatile, it's crucial to pull back, concentrate on long-term investments, and wait for the ideal moment to act. Following Charlie Munger's suggestion of being patient, disciplined, and reasonable during a recession may help investors uncover undervalued opportunities and construct a solid long-term portfolio. In fact, rational, long-term value investing is a winning approach. All in all, Munger states that we must always strive to stay level-headed and think about the bigger picture. It's important to avoid making impulsive decisions, especially when the odds are not in our favor. One way to mitigate this risk is to invest in high-quality companies that have a strong competitive advantage, also known as a moat. These companies are more likely to withstand market fluctuations and provide long-term growth. Remember, as Munger says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble.